There's a small group of unelected officials who meet several times a year in rooms most people will never see, make decisions that most people never hear about, and produce consequences that affect the price of your groceries, the size of your mortgage payment, whether you can afford to buy a house at all, and whether your employer can afford to keep you on payroll. These are the central bankers, and the mechanism through which they shape every financial reality of your life is one of the least understood systems in the modern economy. What they actually do. A central bank, the Federal Reserve in the United States, the Bank of England, the European Central Bank, the Bank of Japan, sits at the apex of its country's financial system. Its primary lever is the interest rate, the cost at which banks can borrow money from the central bank itself. This single rate cascades through the entire economy. When the Federal Reserve raises its funds rate, commercial banks raise their own lending rates in response. Mortgage rates rise, auto loan rates rise, credit card rates rise, business loan rates rise. The cost of borrowing money, for individuals, for companies, for governments, increases across every product and every sector simultaneously. When the Fed cut rates to near zero in 2020 in response to the pandemic, mortgage rates dropped below 3% for the first time in decades. Home buyers flooded the market. Prices exploded. Not because more houses were built, but because the cost of borrowing to buy a house had been reduced artificially. Assets inflated in value. People who owned assets before 2020 became significantly wealthier. People who were trying to become first-time buyers in 2022, when rates rose to 7%, found they could afford half the house they could have in 2021 for the same monthly payment, the same asset, the same house, the same buyer, different interest rate decision by 12 unelected committee members, different life. The Cantillon effect. This is the part central banks do not advertise. When a central bank creates money, through quantitative easing, through bond purchases, through expanding its balance sheet, that money does not arrive equally distributed across the population. It enters the financial system through banks and financial institutions. The people and entities closest to the point of money creation benefit first, before inflation erodes purchasing power. By the time newly created money reaches the broader economy through wages, prices have already adjusted upward. The economist Richard Cantillon identified this mechanism in the 18th century. Its modern expression is straightforward. Quantitative easing inflates the value of financial assets, stocks, bonds, real estate, before it affects wages. People who hold financial assets benefit immediately. People whose primary economic activity is selling their labor benefit last, if at all. Between 2010 and 2022, during the extended period of near-zero interest rates following the financial crisis, the S&P 500 rose approximately 400%. Median wages rose approximately 20%. The gap between those two numbers is the Cantillon effect operating at scale for a decade on the entire American economy. The unelected architects. The Federal Open Market Committee consists of 12 members. None of them are elected. They are appointed, primarily by financial institutions and presidential administration processes that remove them several degrees from any democratic accountability. Their decisions are made behind closed doors and announced through carefully worded statements that move global financial markets before most ordinary people have had time to read them. This is not a conspiracy. The structure is intentional, and its advocates argue it is necessary. That monetary policy requires insulation from short-term political pressure to function effectively. That argument has real merit. The consequences of the structure are also real. The price of food, shelter, transportation, and debt, the four things ordinary people spend most of their income on, is substantially determined by decisions made by people no ordinary person voted for, in a process no ordinary person observes, using mechanisms no ordinary person was taught about in school. The interest rate is not an abstract financial concept. It is the dial that controls the cost of your life, and the people who turn that dial have never been on a ballot. Like and subscribe for more on the financial systems shaping your world. Drop a comment. Did you know central banks work this way? Thanks for watching.